Welcome to StokTok's deep dive into Nestle. Nestle is the world's largest food and beverage company, operating through a portfolio of some of the most recognizable consumer brands globally, from coffee and confectionery to infant nutrition and healthcare products. The company generates the vast majority of its revenue through sales to retailers and food service operators in markets across North America, Europe, and Asia. As of May 8th, the stock is trading at $99.81. Over the past 52 weeks, Nestle has traded between a low of $86.98 and a high of $109.59, meaning the current price sits in the middle of that historical range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Nestle operates through multiple business segments: beverages, including coffee and water and nutrition, spanning from infant formula to clinical nutrition, prepared dishes and cooking aids, confectionery and pet care. The competitive moat here is brand-driven. Decades of marketing investment and consumer trust have given Nestle significant pricing power. Switching costs are moderate. Consumers can switch brands, but distribution scale and operational efficiency create a cost advantage that competitors struggle to match. The StokTok score for Nestle comes in at 24 out of 100, flagged as a void. Breaking this down, valuation receives a 3 out of 20, financial health an 8 out of 20, profitability an 11 out of 20, growth a 2 out of 20, and smart money activity a 0 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? Nestle trades at a price-to-earnings multiple of 22.77 times on trailing 12-month earnings. The forward price-to-earnings sits at 17.42 times, suggesting modest earnings growth expected by the market. However, the PEG ratio, which divides the PE multiple by expected earnings growth, stands at 8.28. That is exceptionally high. As a reference, a PEG ratio below 2 is considered attractive, meaning investors are paying roughly $8 for every dollar of expected earnings growth. The enterprise value to EBITDA multiple sits at 15.97 times, which is elevated for a consumer packaged goods company facing mature market dynamics. On valuation grounds alone, Nestle does not appear to offer a margin of safety. Our DCF analysis, a bottom-up model of discounted future cash flows, suggests the stock is trading at an 18.92% premium to intrinsic value. This means the market is pricing in a rosier scenario than the fundamentals support. Wall Street analysts have a consensus mean price target of $113, with targets ranging from a low of $94 to a high of $128. This mean target implies upside of approximately 13% from current levels. However, that consensus masks significant disagreement. The range spans from downside risk to meaningful upside potential. Taking both signals together, a reasonable fair value range in our view sits between $94 and $110. The current price of $99.81 sits in the lower half of that range, but the DCF premium suggests limited margin of safety even there. Market sentiment around Nestle leans bearish, as consumer-facing companies face headwinds from rising input costs and pressure to cut costs while maintaining pricing power. Geopolitical tensions and divergence in earnings reports across the sector have made investors cautious. On valuation, we view the setup as stretched. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point accounting quality checklist developed to screen for financial health, comes in at 5.0 out of 9. This is below the midpoint, suggesting mixed signals in the underlying accounting. Specifically, the score reflects deterioration in cash generation relative to net income and declines in asset quality. The Altman Z score, a multi-factor model designed to predict bankruptcy risk, registers at 2.95. That places Nestle in the gray zone, not in immediate distress but not comfortably in the safe range either. A Z-score above 3 indicates low bankruptcy risk. Below 1.8 indicates high risk. At 2.95, Nestle sits between these poles. Now to the debt picture. The cash-to-debt ratio is 0.10, meaning the company has only 10 cents in cash for every dollar of debt. This is quite tight and limits financial flexibility. Interest coverage, earnings before interest and taxes divided by interest expense, stands at 7.67 times. That is serviceable and indicates the company can cover interest obligations comfortably, but it is not a fortress. The current ratio, which measures short-term liquidity by dividing current assets by current liabilities, comes in at 0.79. This is below the conventional threshold of 1.0, suggesting potential near-term liquidity strain. Finally, debt to equity is 1.76, meaning Nestle has $1.76 in debt for every dollar of shareholder equity. This is moderately elevated and constrains the balance sheet. Overall, the financial foundation shows stress, tight cash relative to debt, moderate leverage, and an F score below the midpoint signal that financial flexibility is limited and working capital management warrants attention. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, or return on invested capital, is 8.83%. Return on invested capital measures how effectively the company deploys both debt and equity capital to generate profits. As a baseline, cost of capital for a large multinational is typically 6 to 8%, so Nestle is only narrowly exceeding the hurdle rate. This suggests the company is not deploying capital with exceptional efficiency. Gross margin, revenue minus cost of goods sold, divided by revenue, sits at 45.83%. This is respectable for a consumer packaged goods company and reflects brand strength and scale. However, operating margin, which measures earnings before interest and taxes as a percentage of revenue, comes in at 15.55%. The spread between gross margin and operating margin is 30 percentage points, indicating substantial costs in distribution, marketing, and administration. Net profit margin, the bottom line after all expenses and taxes, is 10.05%. The gap from operating margin reflects the impact of interest expense and taxes. Finally, free cash flow margin, the cash generated after capital expenditures, divided by revenue, stands at 12.30%. This is healthy and suggests Nestle converts its profits into actual cash reasonably well, though the gap between operating margin and free cash flow margin indicates meaningful capital intensity. Overall, the profitability metrics show a business that is profitable but not expanding margins. Return on invested capital is mediocre, and the business requires capital reinvestment to maintain its position. Onto growth. Is this business expanding, and at what rate? Over the trailing 3 years, revenue declined at a rate of 1.80% per year. This is contraction, not growth. However, over the trailing 5 years, revenue grew at 3.40% annually. This tells us that Nestle experienced a period of growth 5 to 3 years ago, but momentum has stalled in more recent periods. Book value, which represents shareholder equity on a per-share basis, fell at a rate of 6.80% annually over the past 3 years. This decline reflects losses or minimal earnings relative to shareholder equity, which is concerning. Book value should generally grow in line with the business, and this persistent decline suggests the company is not creating shareholder value at a sufficient pace. The dividend yield is 4.04%. Nestle has historically been a dividend payer, and this yield is meaningful relative to broader market averages. For income-oriented investors, the dividend provides some return, but it does not offset the lack of underlying business growth. In summary, Nestle is in a mature, slow growth phase. The 3-year revenue decline is the most concerning signal. It suggests the company is losing share, facing pricing headwinds, or both. The 5-year growth rate is respectable, but masks recent deceleration. For a company trading at a 22.77 PE multiple, revenue contraction is a red flag. Now let's talk smart money. What institutional capital is actually doing with this name? Among top-tier investors tracked by Dataroma, one guru currently holds Nestle, Thomas Russo of Gardner Russo & Quinn, who allocates 5.99% of his portfolio to the position. However, Russo has been a net seller, reducing his stake by 2.79% in recent filings. This is a significant warning signal. When a skilled long-term investor is trimming, it often precedes deterioration. On the institutional front, only 0.40% of all 13F filers, meaning just a tiny fraction of large institutional investors, are net buyers of Nestle. For context, a healthy stock typically sees at least 5 to 10% of institutional filers buying. A reading of 0.40% is extraordinarily weak and suggests the smart money is either holding or exiting. Insider ownership among company management is 0.00%. This is notable and perhaps troubling. When management owns essentially none of the company, there is limited alignment between management incentives and shareholder interests. Management compensation may be structured in a way that encourages short-term decisions rather than long-term value creation. Over the past 3 months, there have been 0 insider stock purchases and 0 insider sales. The absence of insider buying is telling. When executives are not buying stock at any price, it suggests they do not view the valuation as attractive from the inside. Together, the smart money picture is unambiguously negative. The lead guru is selling, institutional buying is negligible, and management owns nothing. And finally, the verdict. Let's bring it all together. On valuation, Nestle trades at a premium to intrinsic value with a stretched PEG ratio and elevated multiples for a no-growth business. On financial strength, the balance sheet sits in the gray zone with tight cash-to-debt and leverage that limits flexibility. On profitability, the company is profitable but generating mediocre returns on capital with no margin expansion. On growth, revenue has contracted over the past 3 years, book value is declining, and momentum is deteriorating. On smart money, institutional investors are selling, management owns nothing, and the lead guru is trimming his position. In our view, a fair value range for Nestle sits between $94 and $110, representing downside of 5 to 6% from current levels. The current price of $99.81 sits in the middle of that range, but the lack of margin of safety and the stalled growth trajectory mean there is limited upside from here. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Nestle. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.